Moshe Katri, Managing Director, Investment Banking at Wedbush. Moshe, good morning and welcome to the show. Your read of the commentary that's coming from TCS, and how do you see it in terms of reacting from a stock price perspective?
TCS's commentary is not surprising. I would say the numbers are probably a bit better than feared. It kind of shows that despite the volatility and the macro uncertainty, if you're focusing on the cost takeout bucket, you should be able to perform okay in this environment. Typically the March quarter is not the best quarter, it's seasonally weak. We did think that we're probably going to see some pauses in spending during the March quarter. In fact, that's what management said, that they've seen some pause in March. But all in all, considering the fact that in general the sector is down easily north of 20%, a lot of it is probably factored in those multiples and valuations for a lot of those companies. Now, we're still in a very fluid situation in terms of what happens with tariffs, what happens with the global economy and the macro. So, at this point, things can really go south from here, or things can kind of stabilize. And no one really has that crystal ball to tell you where it's going to go.
Good morning, Tamanna here. I'm going to come back to TCS just for a bit. Now, would you look at TCS in comparative, that is it comparatively in a better position to weather the storm that could come? Or would we look at the numbers purely in the Q4 perspective and say that yes, the numbers have been a tad disappointing. The deal pipeline's looking okay, but that's a forward-looking statement in a time when we don't know what's happening. I'm just wondering which one outweighs it for you? The fact that they would, on a bell curve, maybe look relatively okay, or the fact that the Q4 numbers on the face of it are a tad disappointing?
But even that has to convert. So I think in general, when you look at companies in the space, they operate in two different buckets. One that focuses on cost takeouts that should be doing, okay in this environment, and one that focuses on the more discretionary part of the business, and that continues to be at a pause. So as long as the deal pipeline looks healthy, and as long as these companies are able to convert those deals, they should be able to show some growth. And I'm assuming that's why management suggested that fiscal 26 is going to be better than fiscal 25. But again, ultimately, in times of heightened uncertainty, you will see a pause. You'll see a pause in spending. You'll see a pause in converting deals. Anything can happen. But I think on a relative basis, companies want to have that exposure to cost takeout deals, because in this environment, they should do better.
Moshe, I'm just wondering, so we have been speaking about TCS, but as a bellwether, one would assume that it would give direction to the others as well. And we saw quite a bit of a reaction play out a day before yesterday because people were anticipating this number from TCS. But given what you've just said about people hitting pause, about discretionary spending being in question, how would you look at the rest of the space? And what is your anticipation about what the strongest plays are, relatively speaking?
As I said, I would look for companies that have that diversification.
Okay. We're going to wait for him to come back. So he is reiterating a point that he was making about companies having the right diversification. And I think that point has been made by analysts that have been speaking on this platform. Moshe, you were making your point. Companies that have diversification.
Yeah, we would look for companies that have, their eggs in both buckets. One part of the business is going to be more diversified, more defensive, and then the other part's going to be more focused on the discretionary element. So the defensive piece will continue to perform well in good and bad times. The discretionary element will actually pick up if things stabilize. That's the way I kind of see that. I think you have most of the companies, the tier one offshore companies that are based in India, have a pretty good mix of defensive and growth in their revenue base.